Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, equity markets are trying to decide which way to go on the virus panic. But first, in the US, sales of new homes were up strongly, almost 19% higher in January than the same month a year ago. New home sales are much less than 10% of the residential market there, but all the same, this was an impressive result. American home loan rates remain low and supportive of the real estate industry. The latest compilation of the COVID-19 data is out. There are now 3,181 cases outside China, a rise of 250 since yesterday. South Korea and Italy are now the real hotspots. A week ago, that number was 1,097, so it almost trebled in 1 week. And Japan is also being hit with both the virus and the outsized economic contagion effects. Some think it will push Japan into recession. And the news gets even worse for Japan. An IOC official says the Olympics could be cancelled if the risks were too high rather than moved. And Hong Kong's government is trying economic incentives to battle the virus panic, offering cash handouts of 10,000 Hong Kong dollars to every resident. That's about 2,000 New Zealand dollars. Tax breaks and a raft of subsidies in a 25 billion New Zealand dollar package, or 4% of their GDP, aimed at easing the financial burden on citizens and injecting new life into an economy ravaged by months of social unrest and now pandemic fears. But it'll see them book a huge and uncharacteristic $30 billion budget deficit in 2020. In China, local governments announced an eye-catching total of more than 11 trillion yuan in investment, mostly in infrastructure projects, in an effort to boost the economy that has been hard hit. It's a startling New Zealand $2.5 trillion in projects worth more than 30% of Chinese GDP. And the stock market panic over the economic impacts is dividing into two camps. Asian and European markets are still showing signs of fear. Yesterday, Asian markets fell a further 0.8%, while overnight EU markets slipped again too, although they did show some signs of stabilising at the close. Today, Wall Street has brushed aside fears and turned higher, at one point recovering about half of yesterday's dump. But as the session rolls out, some of those gains are being given up again. In Australia, official data reports large falls in construction completed in the December quarter. They were especially tough for residential building and came in far larger than were expected. The US Treasury 10-year yield is little change from yesterday, now at just on 1.33% and still an all-time low. Gold is down another $5 to $1,642 an ounce, and US oil prices are lower at just on $49 a barrel. The Brent benchmark is also lower at just on $54 a barrel. It's all driven by demand fears. And the Kiwi dollar starts today lower at 63 US cents even. On the cross rates, we're up to 96.1 Australian cents, but against the euro, we're down to 57.9 euro cents, and that's our weakest against them in 3 months. That means our trade-weighted index has dropped below 69.1. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.